This year, the IRS sent back $129 billion more than expected. Most people had no idea why the refund was bigger. The reason is a law that passed on July 4th, 2025, called the One Big Beautiful Bill Act. It changed 6 major parts of the tax code overnight. Some of those changes were retroactive to January 1st, 2025, meaning you already qualified before you even heard about it. But here is the problem. The IRS did not update withholding tables right away, so millions of Americans overpaid all year long, and now the government is giving it back as a lump sum refund. The average increase is up to $1,000, but some people are leaving thousands more on the table because they do not know what changed. Today, we're going to walk through every single change, show you who wins, who does not, and tell you exactly what to do before your next paycheck so you stop giving the government an interest-free loan. Meet Nadia and Marcus. They both live in the same city and both earn about $55,000 a year. Nadia works as a waitress and has 2 kids. Marcus works at a warehouse and picks up overtime shifts every week. They both filed their taxes this April. Nadia got $1,800 more than she expected. Marcus left about $3,000 on the table. Same income, same city, completely different outcomes. The only difference is that Nadia learned about the 6 changes. Marcus did not. Here's each one. The first change affects almost everyone. The standard deduction went up. If you file a single, it is now $16,100 for 2026. Married filing jointly, $32,200. Head of household, $24,150. That means the first chunk of your income is completely tax-free, and that chunk just got bigger. For a married couple, the increase from last year means roughly $200 extra stays in your pocket. That might not sound like much on its own, but this is the baseline. Every taxpayer who does not itemize gets this automatically. The One Big Beautiful Bill also made the 2017 tax rates permanent, so the lower brackets are locked in. The second change hits families. The child tax credit went from $2,000 to $2,200 per qualifying child. For Nadia, with 2 kids, that's $400 more. But there's a new piece most people missed entirely. A program called Trump Accounts lets parents open an investment account for each child and contribute up to $5,000 per year until the child turns 18. For babies born between January 1st, 2025 and December 31st, 2028, the government deposits $1,000 as a seed contribution. Nadia's youngest qualifies. Marcus doesn't have kids, so he skips this one, but if you have children under 18, this is money you need to know about. The third change is the one that transformed Nadia's refund. If you work in a job where tips are customary, restaurants, bars, salons, hotels, you can now deduct up to $25,000 in tip income from your taxable income. That's not a credit, that's a straight deduction. For Nadia, who earns about $15,000 a year in tips, that wipes her entire tip income off the tax map. At the 12% bracket, that's roughly $1,800 in savings she never claimed. That's exactly where her surprise refund came from. The deduction phases out if your modified adjusted gross income goes over $150,000 for single filers or $300,000 for joint. If you earn tips and your tax preparer did not apply this deduction on your 2025 return, you can file an amended return right now. The IRS accepts them electronically. This is real money that a lot of tipped workers are leaving behind simply because the law is so new. The fourth change is the one Marcus missed completely. If you earn overtime pay under the Fair Labor Standards Act, you can now deduct the premium portion. That's the extra half of time and a half. The cap is $12,500 for single filers and $25,000 for joint. Marcus picks up about 10 hours of overtime every week. Over a full year, his overtime premium adds up to roughly $8,000. At the 12% tax bracket, that's almost $1,000 in savings he never claimed. Same income phase out as the tips deduction, $150,000 single, $300,000 joint. Many tax filing tools did not include this deduction automatically in early 2026 because the law was so new. If you work hourly and regularly earn overtime, go back and check whether your preparer applied it. If they didn't, file an amendment. Do not leave that money sitting with the government. The fifth change is for anyone 65 or older. there's a brand new deduction of $6,000 on top of everything else you already qualify for. If both you and your spouse are 65 or older and filed jointly, that doubles to $12,000. A qualifying married couple over 65 could now claim a combined deduction of up to $46,700 before paying a single dollar in federal tax. The phase-out starts at $75,000 for single filers and $150,000 for joint, reducing by 6 cents for every dollar above those thresholds. If you have parents or grandparents living on a fixed income, send them this video. This single deduction could mean hundreds of dollars back in their pocket, and most seniors have never heard of it because it didn't exist until last July. The sixth change is the biggest deal for anyone in a high-tax state. New York, California, New Jersey, Illinois. The state and local tax deduction cap just went from $10,000 to $40,000. That's a 4 times increase. If you're a homeowner paying $30,000 or more in combined state income tax and property tax, this change alone could save you thousands. A married taxpayer in the 32% bracket with $40,000 in state and local taxes would see a tax cut of roughly $9,600 more than under the old cap. But there's a catch. This increase only runs through 2029, and 2030 it drops back to $10,000 unless Congress extends it again, and it phases out once your income passes $500,000. Now for the part nobody wants to hear. Not everyone benefits equally. If you earn $33,000 or less, the average refund increase from this law is just $18. Most of these changes are deductions, not credits. If you already owe zero in federal income tax, an extra deduction does nothing for you. On the other end, the top 1% sees an average increase of $908 because phase-outs limit what high earners can claim. And the biggest question is how all of this gets paid for. The answer includes cuts to Medicaid spending and the elimination of the electric vehicle tax credit as of September 2025. The law also adds complexity: new deductions, new phase-outs, new accounts, new sunset dates. The tax code didn't get simpler. It got more generous for the middle, more complicated for everyone, and more expensive for the country. Whether that trade-off is worth it depends entirely on where you sit. The difference between Nadia and Marcus isn't how much they earn. It's that Nadia checked the new rules and Marcus assumed nothing had changed. The tax code has always rewarded the people who read the fine print. Here's what you do right now. Pull up your most recent pay stub and check whether your withholding changed after July 2025. If it didn't, update your W-4 so you're not overpaying for the rest of 2026. If you already filed for 2025 and missed the tips deduction or the overtime deduction, file an amended return. The IRS accepts them electronically now. If you're 65 or older, or you have family members who are, make sure that $6,000 senior deduction was claimed. And if you're in a high tax state, check whether your preparer used the new $40,000 SALT cap or the old $10,000. And if you want to know exactly where to put that extra refund money so it actually grows instead of sitting in a checking account earning nothing, watch this video next.